Hey Eric, how are you?
Good. How's it going, Christy?
I am good. So let's jump right in. Today, our third topic is on, hey, how much money do I need to buy a home? I think there's a lot of confusion or misconception around, how much money you need down. I've heard a lot of people say, well, don't I need 20% down? I don't have $20,000 or $40,000. But the reality is that there are several loan products out there, and that is why it's so important to talk to a lender like Eric, so you can get the right loan product for you and your circumstance.
Definitely appreciate the kind words for sure. And that's exactly right. I mean, we get this a ton. There's definitely a lot of misconceptions, especially with, I think, like our like sort of millennial generation. It's kind of been beaten into us over the years that you have to put 20% down to buy a house. And quite frankly, not only does that not make sense financially, it's also just not true. We have conventional down payment options with as little as 3% down. You have options for veterans and more rural houses with nothing down. You also have down payment assistance options for first time home buyer that allows you to purchase a house without any cash out of pocket at all. So there's tons of different options. And in structuring that, a lot of people again, just either weren't aware of that or think that that's some huge expense to purchase. But I kind of say it like this: when it comes to your mortgage, think of down payment funds as kind of expensive money. You're putting down $25,000 to save about $100 a month on your mortgage payments. Again, because of the rates being very competitive these days, because we're talking about 30-year terms, you're really looking at about $100 in monthly payment difference for every $25,000 that you put down. So again, any ROI calculator will tell you this is probably not a good investment. And in general, again, I think that exploring some of these lower down payment options can really look attractive when you couple that with investing your money and investing down payment funds and allowing you to invest at a greater rate in the future.
Awesome. Now, if somebody did have the 20% or didn't have the 20% but wanted to get to the 20% to avoid mortgage insurance, can you kind of talk about, what mortgage insurance is and if somebody doesn't have the money, if they can borrow it from a family member?
Great question. I think mortgage insurance gets a bad rap too because it's a fee at the end of the day, right? We all don't like paying fees, but this is one of those insurance fees that's actually really beneficial because it allows all of us to really get very competitive interest rates and put less than 20% down. Now, mortgage insurance has gone through a series of changes over the years where there's many different ways to pay mortgage insurance. You can do things like build it into the interest rate of the loan. You can do things like pay it all at once at the closing table or finance the total amount in your loan. The most popular or the most common way to pay mortgage insurance is in the monthly payment, though. There's the most amount of mortgage options with less than 20% down that allow you to include this in your monthly payment. And, this does range based on, and it is on conventional loans at least, a fee that is based on not only your down payment amount, but also your credit score and a few other factors as well, your monthly cash flow, things like that. So I've seen these fees, for top tier, as little as $20 per month, and even below that, I've seen them, up to $100 a month. It just kind of depends on the specific situation. Now, if you structure it in your monthly payment, this will fall off for you when you have 20% equity based on what you've bought the house for. What we do in our, for me and my team, we actually have this really cool service called HomeBot, where we send all of our past clients kind of an estimated valuation of what their home is based on what home sales they're doing in their area. So they can track along as their home goes up in value. And once they do have 20% equity based on a higher value, if their home goes up in value, typically in Central Ohio, we see that homes go up by about 3 to 4% per year. It's been a lot more than that over the last few years, don't get me wrong. But in general, since it's been studied, it's about between 3 and 4% is what you can expect your home to appreciate every year on average. So if you put down, let's say, 5% at the closing table, and your home's going to go up by 3 to 4% per year based on average market appreciation. and you're on a fixed rate loan where your mortgage balance is going down every single time you make a payment, it's likely that between years 3 and years 5, you're at that point where you have 20% equity. If you're using a higher value than what you bought the house for, we may make you do an appraisal or at least be able to pull comparable sales to verify your higher value is accurate. And if we can verify the 20% equity is there, then we can get your monthly mortgage insurance removed. Now, again, there are other ways to pay mortgage insurance. You can finance it in a loan, put it in the interest rate of the loan, pay it all at the closing table. This option, where it's going to fall off of your mortgage payment, only applies if you put it in your monthly mortgage payments, which overall, I like this option. If you're in a market like Columbus or like Central Ohio, where your home is consistently seeing an upswing in value. Some of the bigger markets, like your New York or San Francisco, where now, for the first time, you're starting to see home values go the other way because population is actually declining. I would definitely not recommend a monthly mortgage insurance option because it's based on the predication that your home is going to go up in value to get rid of it faster. So.
I bought my house in Clintonville back in 2017. It was my first home, and I had mortgage insurance on it. My parents helped gift me some money, but I didn't want to. I didn't put the 20% down because I didn't need to. So I was okay with that. I think it was $36 a month, so it's not going to break the bank. It's like what, 3 Chipotles. So that's how I always count everything in
Yeah,
Chipotle.
you say yours was $36 a month?
Yeah, it was, and now I've since moved.
Yeah,
I took the equity in my house in Clintonville and have purchased another home and was able to put the 20% down. But yeah, so that's something like Eric's saying. I've seen a lot of people their first round they'll put 5% down and they always pay mortgage insurance, and they come back to me 3 to 5 years later and they say, okay, I'm ready for my second home. Help me sell this and buy the next one. And then we'll actually talk about this in the next segment. But being able to purchase your next home without having to sell your first home. But anyway, we'll talk about that at the next topic. So, can you explain gift funds real quick? Gift money.
yeah, great question. I guess even kind of like higher level than that, there's only a few places that you can use or a few sources for eligible funds
Mm-hmm.
for mortgage. So in general, a mortgage down payment can come from your checking and savings accounts, your investment account, basically your assets. We want to see that it's been seasoned for a period of 30 to 60 days, meaning that it is in your account and it's used to being in your account. So there's no money laundering or anything like that going on. Aside from your accounts, down payment funds can come from a gift from a eligible donor, which is defined as a direct family member. So a father or an in-law or a brother or a sister can give you funds to go towards the closing table as well. Aside from gifts and aside from your own seasoned funds and investable assets, down payment funds can basically come from the federal government in the form of down payment assistance, different down payment assistance programs like we alluded to earlier. Those are really the only places a down payment can come from. Outside of that, I guess the only other thing would be your equity on your current home through a bridge loan, which we'll talk about that more tomorrow, but that's if you're selling a house and things like that. So in general, if you're buying a new house, your funds saved up over time in investment accounts, 401ks, retirement accounts, checking and savings, a gift from a family member or gift from an employer can also be an eligible source as well. And then down payment assistance funds through the federal government programs or different down payment assistance programs.
Awesome. Thanks for all that. And so once you've spoken to Eric and you find out what loan program works best for you, you're going to have your down payment and closing costs, which could be around, it fluctuates, but it could be around 3% of your loan amount. And the closing costs that you'll have to pay are toward lender fees, title fees, and then your first year of homeowners insurance. Two additional fees that you might have in a very competitive seller's market like we have today would be, maybe paying a portion of the seller's closing costs and potentially, covering an appraisal gap. So on the topic of appraisal gap coverage, Eric, what is an appraisal?
Yeah, great question. I think that was all a ton of great information for sure. An appraisal is a basically a report that is meant to determine what the house is worth for financing purposes. Now, two misconceptions here. Number one, appraisers are not out to get anybody and they are simply trying to assess what the value of the house is. They actually don't really use as much data from the specific house as you would think. They don't look at, all the nitty gritty things with the house. They do inspect it and make sure that it's up to code. But in general, the value of the house is really coming from comparable sales, typically within a mile of the house. Typically, the hope would be the same neighborhood. And the term comparable there means similar size in square footage, bedrooms, bathrooms, some of those key features with the house. So they're looking for a similar home in the area that has, here's the key, sold within the last year. Not listed for sale, not a pending sale, but an actual full-blown sale over the last year. So if there is 3 houses near your house that have sold within the last year for a certain price, and those houses are kind of similar to yours in size and scope, those would be good comparable sales. And that can ultimately determine what the value of your house is. The second misconception I see with appraisals is that there is and it's very important we understand this, there's a big difference between the appraised value of a house and the market value of a house. The market value of a house is determined by the market. It's determined by supply and demand. It's determined by how many houses are available and how many people want to buy those houses.
And what the
This is
buyer is
where
willing
we,
to pay for the house. That is a very important part.
right, right, what we will pay for the house. Because let's be honest, in our market right now, there are fewer homes, there's more buyers, and people are willing to pay a higher price than the house is worth. That's where you get what's called the appraisal gap, like Christy said earlier. And what the appraisal gap really is the difference of the appraised value and the market value of the house, what you're buying the house for versus what the house is really worth. Now, appraisals, the value typically changes a little bit slower over time because, again, it's based on a sale price in the neighborhood. You see this with new build neighborhoods all the time. The price starts low and gradually works up as the homes get complete, and then the back of the neighborhood seems to be more expensive than the front of the
All the
neighborhood.
time.
Exactly. So it's the same thing with market value versus appraisal value. As the market value goes up, the market value can go up very high, very fast. And then slowly over time, as more of those homes sell at those prices, we see the appraised value slowly catching up. But there's that difference between where the appraisal is now and where the market value is. That's an appraisal gap. And that could be something that you have to pay if you're wanting to purchase the house and make your offer as competitive as possible and ultimately have your offer accepted.
And I will say, like, I don't know, 5 years ago, we were just waiting because, part of the purchase contract actually has an appraisal protection in there for both the buyer and the seller. If you're willing to pay 210,000 and it comes in at 200,000, typically the response would be for both parties, to give $5,000. So you would come up five and the purchase price would come down five. You just split it 50-50. Technically it was a lose-lose. But, everybody ends up, going out. The seller makes money and the buyer gets the house. So these days we're kind of having to, guarantee an appraisal gap coverage. So let's use that same example. So if we want to go in at 210 and I put my appraiser hat on and I say, hey, I think it's only going to appraise probably about 200, then, I kind of give the options of, we can either bridge a portion of the gap, or we can offer to pay the full gap, or there's a lot of strategies that, I will explain if you, choose to work with me on how to win against other competing offers. But, 5 years ago, it was kind of let's wait and see what happens when the appraisal happens and then kind of figure it out then. Now it's like when the seller has 10 offers in hand, they're going to probably take, something that has more of a gap, because I could offer $300,000 for that $200,000 house. I'm not going to outsmart anybody by doing that. So, if I say 210 and I'll offer up to 10,000, or bridge that 50%, that I think it's going to appraise low. So again, this is all very extra information that you don't need to know right away. But was there anything else that you wanted to add, Eric, on how much money to bring to closing?
Going back to what you said earlier, Christy, it's really important to understand closing costs.
Mm-hmm.
I think that's another misconception. A lot of people don't know what closing costs are, and there's a lot of like kind of smoke and mirrors when it comes to closing costs. Like I see a lot of lenders offering credits to go towards costs and raising different costs here and there. It's like I said, it can be a little bit confusing, but in general, there's three types of closing costs. That is the fees to use your lender, the fees to have the title of your home transferred into your name by a licensed title company. Typically in Central Ohio, those are picked for us by the sellers. So we don't usually know how much that's going to be exactly up front, but we typically guesstimate anywhere between 1,000 to 1,300 or 1,400, depending on the title company. And then lastly is your first year of insurance paid in advance. Taxes are a year in arrears. Insurance paid in advance. Just like when you buy a car, you have to have insurance before you drive it off the lot, and you have to pay for that insurance for the next 6 months or the next year. Same thing with the house. You have to pay for insurance at the closing table for the next year. It'll be included in your mortgage payments, or can be included in your mortgage payments going forward. But those would be for the following year.
Awesome. And just to reiterate, we will be on Facebook Live in 2 days on Thursday at 7 p.m. I'm going to post the link in this description, and I'll post it in tomorrow's description as well. So the last segment that Eric and I are going to cover will be on how to purchase a home non-contingent on your home selling if you have a home to sell. So back to that, nod of toward a bridge loan. And like what I did with using the equity in my first home to buy my second home. So
yeah, I'm really excited about tomorrow's topic as well, and about the segment on how to sell a home and buy a home in this market. Just because I'm looking around at my houses, and I see all of our friends, kind of looking, that have bought houses with us, and you, Christy. I mean, we've been doing this for a long time, so we look at our past clients are calling us now. They're like, hey, I can sell my home. And I'm like, yeah, we made you a lot of money, but
yeah.
What do we do with it? Where do we go now? How do we structure this in a way that we can get into another house? Because when you're selling at the top of the market, the unfortunate part is you're also buying at the top of the market. So really excited to talk about that and address that, and show you some strategies in which you can buy low and sell high, as ultimately the hope. So
Awesome. Well, I can't wait to dive in. So we'll see you guys later.
thanks, guys.